So there are three variables. When we look at the Indian story, there are three variables that go into the end result with compounding, right? So the first variable is starting amount, right? What do you start with? Second variable is what is the rate of return? And the third variable is the length of the runway. And these three have an interplay. So we saw that you can start with 2.4 cents with a really long runway and end up with a really big number at a relatively low rate of compounding. Or you can have a, kind of above index rate of compounding, like I was giving my daughter about 15%, smaller runway, not that much starting capital, but still end up with a large number. And so it's really important to start as early as possible. Warren Buffett says that I bought my first stock when I was 11. I was wasting my time before then. So anyway, I just wanted to just set the stage where basically I just say that these are really simple concepts. But Charlie Munger used to say you have to take a simple idea and take it very seriously. And compounding is a very simple idea, but it has a lot of power if you fully unleash it. And Einstein called compounding the eighth wonder of the world. And we humans have difficulty with the concept of compounding because it's not linear. It's basically on a log scale. We don't normally think in a log scale. But it's really important to think in those terms. My younger daughter, she went to NYU and we were living in California at the time. I used to pick her up at like 1 or 2 o'clock in the morning from LAX, and we were about 50 miles away. So we had a long hour plus drive back home. And, she's kind of falling asleep, etc. So one time I decided this is a good time to give a lesson on compounding. So I told her, hey, Momachi, I said, you're going to have this internship in the summer and you don't really need the money. You're going to save about $5,000 over the summer and you're 18, right? And I said that let's say we put that money in an IRA, retirement account, which is not taxed. And let's say you gave me power of attorney on that account. And let's say I was able to generate a 15% return on that $5,000. So I told her, look, basically 68 is 50 years from 18 to 68. And we are doubling every 5 years. The important thing is how long things take to double. Life is all about how long things take to double. So I said, you'll get 10 doubles. 10 doubles, is a magical number, 1,000. So I said, at 68, you'll have 5 million. But you'll do another internship when you're 19. Maybe you'll make 6,000-7,000. And that'll be another 5-6 million. And then at some point you'll graduate and you'll get a job and you'll actually be able to save a little bit more. So by now she's wide awake, So I said, how much money will you have when you're 68? She said, it's too big a number. My head will explode. So I was happy. She got it, And I said, the important thing is that you have to start early.
Let me ask you a businessman's dilemma that we debate in our office all the time. So let's say I have two options in any business. One is I can do lower ROCE business, which is high growth in my industry. I can veer towards that. Or on the other hand, I can veer towards a higher ROCE business, which is more niche and therefore has lower growth. As a businessman, my tendency would be, let's go with the high ROCE. Growth matters less. But the markets reward exactly the opposite. They won't care whether I'm in the low ROCE business or not, but they'll reward growth. How do you balance this? It's not either or. How do you balance this ROCE versus growth?
Yeah, so I think that this is actually the dilemma Berkshire Hathaway faces. So if we look at something like Berkshire Hathaway today, it's 800 billion market value. They have to put 50, 60 billion out at a time to move the needle. And there are very few places that you can put 50, 60 billion one shot. How many businesses in India have a market value more than that? So the conclusion Buffett and Munger came to was that we have to keep running the runway at a lower rate. And so I would say between the two, it's important to keep compounding. And it's important not to be the flash in the pan, if you will. So if you've got some consistent growth, but it's low ROE, and at the end of the day, it boils down to opportunity cost. So you have limited dollars to invest. If in the near term one is giving you a high ROE, you can put money there, but you may not be able to put much money there. The other one may be able to absorb the rest. And that's how we do it. So everything boils down to opportunity cost.